wealth comes to those who create value in the world. When you're trading, you're just selling stuff, right? Like you're just kind of playing the market. You're not adding value to the asset. And that's, I think, where real estate investors like us, that's where we excel. Is like we buy this asset, but we're not just buying and selling it. When we own the asset, like when we buy apartments, what we do is we go and we renovate the unit, new flooring, new appliances, new paint job, maybe $5,000-$10,000 of renovations per unit, new playground equipment. We're also kicking out the deadbeats and making it a better community. Why? Well, we're not doing it for free. We're doing it so that they pay a little bit more in rent. And when we increase the net operating income, or you business owners out there, the EBITDA, we can sell that property for a higher multiple down the road.
Just a quick pause before we get into this. Trading can be intense, and staying mindful during your session matters so much. That's why I created and am sharing a free 3-part audio experience that's helped me deeply. 1 for starting your day with calm intention, 1 to stay centered while you trade, and 1 to wind down with grace when it's time to stop. These tracks are yours. Just click the link in the description. Hey, welcome back. Here at the Market Mamas podcast, I cover a wide range of topics from the intricacies of day trading to mindset mastery and psychological growth, with the goal of the conversations being next level growth for all of us. My name is Becky, and I'm a US-based futures day trader from the Pacific Northwest. My trading experience includes trading stocks, options, crypto, and futures, with both trading a personal account as well as with prop funding companies. Over time, I found that I most enjoy the fast-paced world of intraday futures trading, so that is my primary day trading focus now. Thank you for joining me on the Market Mamas podcast today. Hey everybody, welcome back to Market Mamas, and I am really excited today because I'm going to shift things up a little bit on us. I really enjoy talking to other traders, but I also enjoy talking to entrepreneurs and people who are figuring out what to do with life and ways to make our money work for us and use our resources a little more wisely. And so today I am really excited to speak to someone who knows light years more than I do about the world of real estate and how we can actually use our money to diversify and make it start to work for us, start to get some passive income streams running. And I think that that's something that really will speak to all traders. So I cannot wait to get into this gentleman's backstory and find some words of wisdom that can help us all figure out how to make more with what we're creating, trading or otherwise. So Lane, welcome so much to Market Mamas today.
Yeah, thanks for having me. Aloha, everybody.
Hey. So you are in Hawaii currently, but you were an engineer in Seattle for your early adulthood, right?
Yeah, graduated in 2007. And then I think for the first year or two after college, I was doing the trading thing a little bit, but as we were talking earlier, I just didn't have the stomach for it. And I just I bet on pre-earning stuff and I just got blown out. So
That'll do
I don't
it.
know. I just kind of, took the wind out of my sails and I went to do, real estate, right? Because real estate's for dummies. So that's what I went and did.
I mean, I think that there is some real estate for dummies, but then I think that you can really make something pretty badass out of it with persistence. So how did you get started in real estate then? Is that what you went to school for?
No, I was supposed to go to school, study hard, do the 401k thing and, buy a house to live in, which they're all supposed to do. And I just kind of followed this linear path. And then because I was a construction supervisor back then, traveling all over for work, never home. So I bought a house to live in, saved up 80 grand on a $350,000 house in Seattle. But because I was never home, and I was in my early 20s, I was like, well, let me just rent this damn thing out.
Yeah.
And then in the beginning, it was like, whoa, this is cool. I got this beer money coming in, right? The mortgage was $1,600, the rents were $2,200. I knew nothing about the 50% rule, rent to value ratios. I'm sure we can get into that today. But yeah, I was just like, wow, this is super cool. And then a few months went by and I was like, wait a minute, if I just kept doing this, I'd be able to fire my boss and quit my job and financial independence. And I was like, yeah, better learn more about this thing.
Nice. Yeah, I too, I went to school for nursing and bought a house and W-2 and retirement account through my work. And then it's there's more out there. So for me, it was trading, but I am so curious about real estate as well. Because my husband and I have one single family rental and there's it's not a perfect recipe right there for success because we run into issues we actually, I don't know if you still follow the Pacific Northwest, but we had flooding in December and that put water in our crawl space. And so what would you recommend for starting? How does that look like for people who aren't deep in the real estate world?
Yeah, I guess the first thing is numbers, right? You got to buy the property where the numbers make sense. And what the heck does that mean? Well, the first thing you look at is the rent to value ratio. So you take the monthly rents divided by the purchase price. So when that first property I bought in Seattle, this is a long time ago. So now properties are double the price, but like 2,200 a month divided by 350,000. So it was just under like, 0.7%. Yeah, and at that point, like you can sort of cash flow, but later on I started to buy properties in Birmingham, Atlanta, Indianapolis, more of these like what you call secondary and tertiary markets. So I guess that's point number two. Like you try and buy properties that aren't in sexy areas, what we call primary markets. So Seattle, all of California, New York,
Expensive.
Boston, Hawaii ain't gonna work, right? Because you're seeing rent to value ratios of like a place that's 400 grand that's in the ghetto that'll rent for $2,000 a month. So that's 0.5%. So that's not going to work.
Okay, so you got to figure out your market, do some research, figure out which cities make the most sense in terms of like home value price that you have to pay, and then what you can rent for it. And it has to make sense fiscally to even be worth your time and investment, because nothing will be perfect, I imagine. So there's going to be some flex with it. So that's probably makes sense as point number one.
Yeah. The numbers got to make sense. I mean, I have an analyzer on my website. If you want to download it for free, it's like thewealthelevator.com/turnkey. But the rental value ratio is a real quick and dirty way of like comparing different rental properties. And obviously you're not buying properties in the super nice areas nor the slumlords. There's a nice little sweet spot in the middle there. But then, as I started to get away from Seattle, like Seattle's a very blue state, right? Like I live in a blue state. Hawaii's a very blue state. It's a great place to live in, but probably a horrible place to be a landlord, right? Because you want the landlord laws on your side. So that's why I started to buy properties.
Can you tell me more about the red and blue states and how that has an impact?
I mean, not to say politically, but typically like in the red states, if people don't pay their rent, they can't stay. And the sheriff comes and like, kicks them out. Where it seems to be doesn't quite work that way in these blue states out there. I'll say that a little quietly, since I know everybody out there lives in pretty much blue states, I would assume, especially. Yeah. But anyway, I'll leave it at that, right? Like that's why I started to buy.
Yeah. There's different laws that are a little more protective of the landlord.
Yeah, a little bit more common sense, I would say, or whatever. If you're the landlord, people can't pay, they can't stay. At least that's how I grew up living. And that's why I started to buy properties in Birmingham, Atlanta, Indianapolis. When I first started, was able to buy properties for like 80, 100 grand that rented for $1,000. So that 1% rent to value ratio or better was out there. And then, so I started to do that in 2012 to 2015. And around there, I had 11 of these rental properties, and it just wasn't super scalable. Like it was great, right? Like in my new book, The Wealth Elevator, I kind of talk about these different levels of wealth building.
Yeah.
When you're a non-accredited investor under $1 million net worth, you do a lot of things, active things. That might be flipping houses, which I never did. That might be buying little rental properties. That might be trading, right? Which is a little bit of trading time for money. Everyone's got to do it. But once you become an accredited investor, $1 million net worth or greater, there's a kind of a pivot point. And that's what I kind of talk about in my book. And that was where I was in 2015. Like these 11 rental properties, at a few $100 of cash flow each. It was cool, like $3,000 a month from these 11 rentals. Yeah. It's like a third paycheck. But, most of my clients today, they're looking for $10,000, $20,000 passive income per month. So with 11 rental properties, I had maybe an eviction or two every single year, some kind of big catastrophe that happens every quarter, like you mentioned, right? Like, some floods or tree falling on your house, something.
It's a real thing.
I always had professional property management doing my dirty work for me. You pay them 10% of the rents. It is what it is. But that helps you scale, right? Because obviously your highest and best use is doing this podcast and trading, which is how you would make most of your money. But, property manager enables you to scale. But even the rental properties, there's still a limitation. And I think that pivot needs to happen when you're an accredited investor, $1 million net worth or greater.
Right. So you can start there and get single family properties, start to grow, get some passive income from that. But then you will reach a ceiling where there's different ways to pivot that could be more ideal in terms of what you could do with your money now that you're kind of getting deeper into the game, it sounds like.
Yeah. I think the biggest thing is the legal liability, right? Like when you're the landlord or, you're the direct owner of these rental properties, even if you're using an LLC or entity, you're the person who these frivolous lawsuits come to. And if you've ever been sued, it typically takes at least 25, maybe even 50, 100 grand to just defend the damn thing. It's stupid. But that's kind of where in 2015, I started to interact with these accredited investors and started to kind of learn the lay of the land of what people did after a handful of rental properties. And all these guys are selling their rentals and going into these larger syndications and private placements as a passive LP. So, they're buying these big apartments, but without all the middlemen like you would see in a REIT. So you're getting direct access to these types of assets, and then, getting the upside from the value add of the project.
So you can join a group of investors that go in on a larger project, and that protects you legally more so?
Well, you're a passive investor, right? And I'm not giving tax, legal advice, blah, 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 investment advice here. But traditionally, when you're a limited partner, that's what the beauty of a limited partner is, right? Limited liability.
Yeah.
No different than when you're like, you're trading AT&T. I mean, I'm sure AT&T gets sued every single day, several times a day. But you as a stockholder or a limited partner, in this case, in this world, it kind of protects you from a lot of that type of stuff.
Smart. That's what I love about real estate, the way that you're speaking to it, because there is so many ways that like entry level criteria, basically, but then the scalability of it is pretty impressive when you can start to learn more about it. So the wealth elevator, do you teach us more there? What is that?
Yeah, we mostly help like accredited investors kind of get into this world of syndications and private placements, or like what we call like country club deals. I think I'm gonna say half of us have owned rental properties in the past. So, you kind of understand, like you said, you own a property, you kind of understand how the numbers kind of work. You got $1,000 of rent, $100 goes to my property manager, $100 go to something that breaks that month. You got to stick another couple hundred away for rainy day CapEx, big CapEx items to break. You pay your mortgage, you pay your taxes, insurance. You kind of know how the numbers work.
Yeah, you skim off the top.
Yeah. And you need the tax benefits too, which we can talk about later. But when these larger deals, they're just times 100 or a couple hundred units. So you have to look at the deal a little bit more from an institutional point of view. Like, I mean, you probably understand what is in the black box of rental real estate. Again, where I was joking in the beginning is not much of a joke, but real estate's for dummies. It's probably the most archaic business out there. And at least I'm pretty bullish on, what we invest in, like workforce housing. I think the rich are getting richer and the poor are getting poorer, and the middle class are needing to live in apartments or lower level houses. So I think that demand is growing in the future, right? You may or may not agree, whatever, right? But that's what I believe in. Like, I try to invest in things that are going to be having a 10-year plus thesis behind it.
That makes a lot of sense to me. I mean, I think that there is more and more common families and larger career people renting versus buying their homes. The market is shifting over time. And I think that the real estate market will never not be in demand.
Right. Less and less people are having kids, less family creation, needing the mobility, like you said. And, I mean, we're becoming more and more like Asia, right? Where like the 1/3 of your salary is now turning into 1/2 of your salary if you're buying a house the traditional way. And it's just becoming unaffordable, especially with higher interest rates these days. And that'll likely continue over the next decade.
There was that sweet spot post-COVID where hopefully everyone refinanced or got into real estate if they were able to, because that was kind of a nice window there. But it doesn't appear to be receding back to those levels anytime soon.
Yeah, I mean, us real estate guys, we follow the financial curve and the FedWatch too, the CME FedWatch tool. I mean, those are two bookmarks that we have. I don't know if that's useful to y'all out there, but I mean, like, we follow these really big movers like that, and it's kind of like watching grass grow or watching a cruise ship sail out of the harbor. That's why I kind of like it, so I don't have to like watch it every single day like a trader does.
Yeah, it's a different landscape.
Yeah. But I think for us, like, it's, these are like something that's going to be around for a long, long time. But that doesn't mean that you should invest in all of it. But that's what I kind of did in my 20s and going to my 30s. Like, I was heavy into this stuff. But this is like that quantum, I think, that may apply to people listening, right? Like, to get a significant amount of net worth, which I would define as $4 to $5 million or greater, you have to somewhat concentrate or run your own business. You can't just like 60-40 stocks, mutual funds your way there, even though that's what they say you're supposed to do. Again, I'm not giving any investment advice. I'm not a certified financial planner to be able to sell people marketable securities. But to me, you have to have that concentration. Now, I'm kind of getting to a point in my life where I'm kind of wanting to diversify a little bit. I got my real estate pillar, I got my equities pillar, I've got my private credit pillar, and then I got my private equity, buy businesses for higher returns there. That's kind of where I see the lay of the land. I think that's my next book. But, I think the biggest part for people getting started is like, the real estate, right? You're buying businesses, you're buying apartments with other people. You may not know how to operate it yourself, but you find a good general partnership and you invest directly as opposed to going the secondary market through a REIT and a lot of middlemen there.
Yeah, I feel like, if you can do some research on the back end of things and find good people to work with, cutting out middlemen is probably going to be more ideal in the situation, right? Because you can have less to debate about and less percentages to hand away.
Yeah, I think so. But, this is not for everybody. Just like trading is not for
Yeah.
everybody, right? Like some people should stay the heck away from it because they'll probably lose all their money in a week.
Yeah. I think you can find out pretty soon if it like works with your personality and your goals or if it doesn't. And I think real estate is probably, like you said, one of those things as well, where figure out something that makes sense to you, that you enjoy, that you want to scale, and then you can kind of go deeper down in that rabbit hole. And if you can get over that 1 million mark, then you can get into some of those accredited options that you were talking about.
Yeah. And I think the thing that pushed me over the edge when I was doing it is like the taxes, right? Like when you own a little rental property, you can deduct 1/27th of the building improvement for 27 years, which is great, which is typically offset a lot of your income that you're making on the property. I think that first $35,000 property, I was getting maybe like $6,000 or $7,000 of deductions from the depreciation of the asset every year, which is paper losses.
Yes.
And I was making maybe like $5,000 per year on that thing. So that kind of made it sort of tax free.
Yeah, you get to keep
in
the
a
money.
way. Right. But with these syndicated deals, they're large enough for you to do what's called a cost segregation. So basically is you pay like $500 or we pay like $5,000, $6,000 for our reports. But what it's able to do is to take advantage of a lot of the new bonus depreciation laws and much more aggressive depreciation schedules. So oftentimes we can deduct 1/3 of the value in the first year. So that might mean like 10 times the amount of losses the first year than the little single family home in proportion to it.
Perfect. So in the beginning, you can keep more of your cash flow.
Yeah. And now you kind of open up. This is what I realized, like, wow, these guys are playing all these games with their taxes and nobody even talks about, like, using their pooled losses from this one investment that they got that more than offset the cash flow for that one particular property, but now using that to pool their other investments together and offsetting other passive income in their portfolio.
Perfect. So if one property is really upside down in what it has made that year, you can use those losses on your other properties as well as a part of your like real estate work.
Generally speaking, yes. I mean, that's what I've done. I'm not giving any CPA advice here. If people need a referral, they can always reach out. But yeah, that's kind of the basics, right? And then you get into real estate professional status, which some people like to do, and now they're able to offset other ordinary income. I guess that maybe we should have started the way I kind of teach it is you have ordinary income and you have passive income for the most part. Think of it as two different colors of money.
Okay.
Passive income is great, other than the fact it's obviously passive. But from a tax perspective, passive income can be offset with these passive losses or depreciation deductions, which I just mentioned. You get a boatload of it. So this is what's advantageous about real estate. Like a lot of times, you don't really pay taxes on any of the gains because you got more than enough losses to account for the income that you're making. But when you're trading or, selling stocks and stuff like that, or, your W-2 work, your 1099 work, that's all categorized as ordinary income. So there's a strategy out there called real estate professional status. I'm not going to get into that because it's kind of complicated. But what some people will do is they'll use a lot of these losses they get from the real estate to offset some of those ordinary income gains there. And then also in this world, you meet all these accredited investors. You're doing all these things with like oil and gas deals, intangible drilling costs. You guys can Google that on your own. But then this is kind of where I fell into this world of like all these accredited investors investing in all these country club deals and then doing all these things with their taxes and then also running their family finances through an infinite banking plan. I was like, well, this is kind of cool, right? It's like a trifecta of these different strategies that like my parents never knew about.
Right.
And then I got kind of frustrated because it's like, this is stuff any average dude could do, but it's completely opposite than we're all taught.
Yeah, it really is. I think that it's abnormal when we start to learn about these things, and with trading as well. Like I had no idea the way that you could use money and tweak systems and like make it work and take the income from this and buy something else. And then you don't have to pay on that income. And yet you can spread it farther and have more income growing. And so the way that you can essentially use money to make more money and work around the systems with paying taxes and sharing like the losses and stuff. Like I am learning more every year from trading, but then also a little bit beyond that, because it's similar with trading, losses count against your wins. And then you do trading education, you pay your reset fees or whatever, like all of that can be written off against on your trading profits too. And so I think it behooves anyone who has something that's not a W-2 job to dig into this and find out the right people to talk to, because there's so many more ways that I had no idea existed until the last few years that we can actually use money as a tool versus, you have to earn it as a paycheck in order to send it right out for your mortgage bill.
Yeah. I mean, I discovered very early on, like I was like, when I first started my podcast back in 2016, and back then I was teaching people how to buy these remote rental properties, right? Since then, we mostly work with accredited investors who do bigger stuff. But I was like, hey, just go buy like a few rental properties and you pay them off over like 15 to 30 years. And then there's your retirement plan. You never have to work again. And then I was like, my goodness, like if everybody just did that, and it's not that hard to do. The hardest part is saving the money, right? Because you need like 20% down payments. You need to be somewhat prudent to save your money. A lot of my folks are just lucky because they make good salaries and they're able to save $50,000, $100,000 a year to plow into this and expedite them along this path. But it's nothing that the average guy can't do. I mean, if you can save $5,000 per year, which I know is hard for a lot of people, but you eventually save up for 4 years to buy a rental property, and then now you're saving up. Maybe it takes you 3 years to buy the next one, and then it takes you 2 years. I mean, it kind of stacks upon each other, and then you're like, oh wait, now I know why the government or anybody doesn't want you to do this, because then we'll all just sit around and like do nothing, right? Like, I mean,
then we don't want to be employees anymore.
Right. Like who would like want to do any of this type of stuff? Like like who would get our coffee? Who would build our bridges? Who'd be our doctors? Right.
Yeah.
And I'm like, oh, okay. No, this is only for the select few. But I've also gone through ups and downs too, right? I'm sure you have. Like this is not, you're getting off the beaten path with this stuff. And it's not for everybody. I think you need to get educated. And, this is why we also we create a community. We have retreats. Actually, taking everybody out to Denver here next month. But, like you need to get surrounded with other people. And I think people are really horrible about this these days, like especially the Gen Zers that are like, oh my God, he called me. Oh shoot, somebody called me. Right. Like, like you have to build relationships with people, and especially accredited investors need to build relationships with other accredited investors. Like that's the only way you find deal flow. That's the only way you find out who are the bad people out there. That's the only way you like swap lessons learned. It also makes it funner, I think, too. But yeah, I think these are not the skills that everybody has. But I mean, I used to be like a super introverted engineer that, I mean, I didn't want to talk to anybody, but even I learned this stuff that like these softer skills are really required, especially, and then you have to get around the right people.
Yeah. I think that is similar in trading, because trading right now, I'm a retail trader, which means I trade from my home computer, and I have found all kinds of online communities. And so I'm a member of a few really great ones, and I've met wonderful people. But when I have gotten together with them in real life for weekends where we get away and we talk trading and we strategize or whatever, it's incredible. Like having that personal sitting down with other people who speak that same language, which is not super normal. Like I live in suburbia and raising my family. And so I don't have traders around me all the time. And to sit down with people who understand this world that I'm pushing into is really powerful in terms of exactly what you said, like the networking, discussing what you're doing, what they're doing, figuring out who like the weirdos are. And you don't want to put more and more into that relationship. But this guy's super smart and I love what he did. And so I want to like dig into more of that and work on a deal with this person. I think that it's really powerful to actually develop those human to human connections, because it will, I think, strengthen you in terms of what you know and who you know and how you can grow faster together.
Right, exactly. And it's interesting you say the same exact thing, but I think you and I come from like different parts of the universe or multiverse if you're a Marvel fan, right? Like, and I think it all comes together. Like the more and more money you have, like I think you start to diversify to other things, right? Yeah. Like, I mean, I think I mentioned earlier, like when I've been doing real estate for like almost a couple of decades now. And now I'm kind of realizing that I need to diversify into even stocks and bonds and stuff like that. I don't like it, but stuff like that, private equity, life insurance. But you start to realize, like, the people that coming to this pedestal, or what I call the third floor of the wealth elevator, that's after you get to $3 to $5 million net worth. It starts to sort of become a blend of like all these different tools and strategies all in one. But, I think the key is like you have to find your own ladder up to that level in a way first.
Well, that's why I was really actually excited to have you on the podcast today. And most of my viewers are traders, but I'm a 5-figure-a-year trader so far, and I'm pushing at 6, And so we're starting to have some more income. My husband is an engineer and I'm still a part-time nurse. And if other traders are in the situation where you're starting to realize you have a little bit of extra and you want to push it somewhere else, I think that this is an incredible opportunity to buy something in order for your money to start to multiply. And then I love what you said about you save for 4 years and you have a down payment for 1. And then maybe with that being extra income, you can start to save faster and start to build it. And so I think that that's something that will speak to traders, because if you're coming to trading from another career and then you all of a sudden have 2 incomes and you're starting to make money with trading, there is an opportunity of maybe you don't just blow that money on fancy things and trips. Maybe you do a little bit of fancy things and trips, and you also put some money away into real estate. And I think that could be a really nice opportunity for a lot of growing traders that are getting into some profits.
Yeah. I mean, I'm not a trader. I somewhat understand it a little bit, but I think at the end of the day, it's all your net savings. Like whenever all my accredited investors, we always jump on a free consult for folks. And essentially the question I always get to is like, how much do you all save every year, right? Like, I don't care if you make $700,000 a year. Some people spend all of it. But again, for most of our folks in our community, they're saving $50,000 to $100,000 a year. If you're only saving 25 grand a year, you're probably still better than 99% of the people in the country. And it's just a matter of time until you take that and invest it. But that's kind of the key, right? Like if you are only saving $10,000, $25,000 a year, you buy a couple of these rental properties, you pretty much get yourself to that $50,000 a year right away. And maybe that allows you to either trade with another zero attached to all your trades. I think I'm just guessing there.
Yeah.
Or you just keep doing what you're doing, but you have this other supplemental, few rental properties bringing in income. There would be, I would think, the 2 paths of it.
Yeah.
I guess like one tax thing that I think might be useful for your folks. Again, I'm not a CPA, but if you make under a certain threshold, I think it's either $100,000 or $250,000 adjusted gross income, you can use up to $25,000 of those real estate losses every year to offset any income you have. I do believe ordinary too. So I think ask ChatGPT, that guy's like this guy was talking about real estate using passive losses up to 25 grand a year. Explain that more to me. I think that's the prompt to get that. But, I think what's cool is like, there's always for everything that you do. I'm sure there's something for trading for me, but there's always like this minimum effective dose. If you just do a little bit and you get a nice maximum effect of it, and that could be a nice like low-hanging fruit for people and incentive, maybe just to buy one little rental property and get started. Or if you're already an accredited investor, just skip up to just investing as a passive investor in a larger deal and actually getting more tax benefits that way too.
Yeah, I think that there's a lot of ways to work it. And I think it's a great conversation to open up, because I think I love the idea of consulting ChatGPT and figuring this out, because the resources are out there. And there could be a situation where towards the end of the year, you're realizing you actually did pretty well as a trader. And maybe you could rally and use some of your end of the year profits to invest in real estate instead of just leaving it sit or purchasing your next trip or what have you. Like lock that into some sort of an investment strategy, such as a real estate property. And then you don't have to pay on that as income because it came in and went out. And so I think that those work actually really well together.
Yeah, I just think if you're going from stocks, which is ordinary income, there's not really any way to offset that. I mean, that's why the government likes when you trade it, because it's like, it doesn't have the real estate benefits. But I think to go from a little bit of, stocks, bonds, mutual funds into real estate in a way is kind of like a mental stop loss in a way. Right? Because I mean, real estate is an asset that the good thing is it doesn't go anywhere too much in price. It doesn't really go to zero. So if you were to take a little bit of those winnings and just put it in, I mean, you're basically kind of buying like gold or of a commodity in a way.
Right.
I know gold's lately been on fire for other reasons, instability in the government in the
Mhm.
world of economics. But the idea of like real
It's
estate is
physical
sort of like a
commodity.
package commodity, right?
Mhm.
Like it's a diversified pool of different commodities at the end of the day, and it serves utility in the world.
And it's like a bond. I mean, it's like a stable, like you said, the value is not going to go away, and there will be something that you can extract overhead. And holding it long term, I mean, there's always something behind it. And gold and silver, like the physical commodities, have always been seen as something like that, as an alternative to something more speculative, where there's not as much physical item behind it. And I kind of love that about this as well, because when you start getting into bigger numbers and bigger zeros in your situation, diversifying is something that traders understand very well, because putting all your eggs in one basket leaves you very vulnerable. And I think that this is a great opportunity for us to figure out how to, spread our wealth a little bit farther as you start to accumulate.
Yeah, yeah, and at least learn different tax strategies too on the real estate side. But you need to find a way to make income, right? Like if you're not yet to the family office level above 5 million net worth, you have to find a way to trade time for dollars. And I think trading is great, like on your guys' side of the fence. I think that's great way to doing it. For a lot of our folks, they either run their own businesses or they're high paid doctors, dentists, engineers, etc. High W-2 employees. So that's the way they do it. But a lot of this is just like, again, what I was mentioning, like if you can put 25, 50 grand a year, you just keep consistently doing that. And if you're able to shelter your taxes a little bit every year, like, that's how you build wealth over the years.
Yeah.
Like most of the people in my group are in their 40s and 50s. So it kind of takes a while to get over accredited investor status.
That makes sense. And with trading, I mean, you can make more money for a smaller amount of time. You don't necessarily have to work at an office or a salary for 40, 50 hours a week. You can consolidate that into a couple hours in the morning, but that's not available right away. You have to spend hours and stuff to learn it. And then you do have to be at your charts in order to make that money for generally a lot of trading strategies. And so I think what a lot of people would like to do is to be able to create more diversification. So you didn't have to, let's say, be up every single Monday through Friday to execute at market open. You can have more time off from trading and have income working on the background. Like that's a beautiful part of, I think, not only relying on trading once you start finding trading success.
Yeah. Or you could just suck it up and add a zero to your bets, right? I don't know.
Or
I don't know.
both.
I don't
I
know.
like
I don't
both.
trade. So
I think that is definitely an avenue of traders. I think that there's two types of traders once you find successful. I think there's the ones that start adding zeros and then can deal with that leverage up, seeing that type of money fluctuating intraday on your chart, and can start making a trade that would have made you $1,000, make it 10 grand down the line. But then I think there are traders who make 1,000 and they turn into two, and then it's like a comfort level where you're like, and so then they want to maybe only cap out at 25 or 3,000, and they want to like make it a little bit more safe in a way where you are having like a more stable sort of income from there. So I think that there's different ways that we can go.
yeah, at least from our world, like the people that I see in our community, they're super hyper aware of the taxes, right? So they kind of stay away from just buying and selling things for the capital gains. What they'll do is more of like the cover calls with with a portion of their portfolio on that side. So it's kind of like a cash flowing strategy, which makes a lot of sense because on the real estate side, you're basically putting these assets up and working the assets, or in a way like when you stake your crypto, right? You're kind of you're working the asset.
Okay, you do know trading. You know a little bit.
No, I mean I know enough, but yeah, I kind of stay on my side of we operate multifamily syndications and we also do private equity. So
Yeah.
at the end of the day, like it's an asset, right? Like whether that asset is a piece of real estate or paper traded electronic stock,
Holdings in a
it
company.
yeah, and then there's a way, and just like a farm, right? Somebody told me this recently. It's kind of like a farm. It's just like an asset, but in each of these assets, there should be an ability for you to like hold on to the asset, but work the asset so you get residuals or dividends, right? So with the real estate, that's obvious. Well, let's just rent this sucker out, value add it in the process, and then making that cash flow or getting the milk from the cows. The farm is obvious, right? But in a way, you can also do that with trading your paper assets like that too.
Yeah. Absolutely. I think there's a huge market. And one of my good friends and a fellow coach at the company I work for loves covered calls for that exact reason. Like you can make a passive income on a company that you want to hold anyway, that you believe in and you know is seems quite fundamentally sound. You can accumulate shares in that company. And so then that is an asset that you have, and writing covered calls against it will bring you that income basically in a more passive situation. You can manage those on a week to week basis necessarily. So it's not the same like intraday trading energy that I am more privy to and need to diversify from.
Can I get into something that I don't know if it's maybe offensive to you guys group, but like,
Do
yeah,
it.
this is the real estate investors argument, right? Like,
Okay.
what I've heard is like wealth comes to those who create value in the world. When you're trading, you're just selling stuff, right? Like you're just kind of playing the
Buying and
market. You're
selling.
not adding value to the asset, and that's I think where real estate investors like us, that's where we excel. Is like we buy this asset, but we're not just buying and selling it. When we own the asset, like when we buy apartments, what we do is we go and we renovate the unit, new flooring, new appliances, new paint job, maybe $5,000-$10,000 of renovations per unit, new playground equipment. We're also kicking out the deadbeats and making it a better community. Why? Well, we're not doing it for free. We're doing it so that they pay a little bit more in rent. And when we
Yeah.
increase the net operating income, or you business owners out there, the EBITDA, we can sell that property for a higher multiple down the road. So it's not a get rich quick thing. It's not overnight. It doesn't just take a year, but through a couple of years, 2-3 years, you can typically get through most of the units through the natural turnover. As the tenants move out, you renovate the units, bump the rent. But that's typically where we're making most of our money. Again, when we're using leverage, right, with real estate, we're able to magnify those returns. So if we increase the rents by, if the rents are like $900, right, to use a really crude example, and we increase it 10%, which is not that hard to do, to $1,000 a month times 400 units, we've just increased the value of the net operating income by 10%. But since we're leveraged, that may be more than enough to almost double our money through the process. I think that's where like we take our own fate in our own hand. As long as the market doesn't drop out, which it has the last 2023 to 2024 was when commercial real estate crashed for 30%. But if we're trading in a flat market, right, we take our own faith in our own hands and we value add that asset and we make the differential there. So I
I
think
love that.
that's kind of where like we run a business where we're improving the communities, improving the rents, maybe even cutting the expenses in some cases. But I think that's the name of our game. Like we run a business where we inject value into the asset.
Yeah. And I do love that. And I hope that no one is offended. But if they are, then that's their own issue, because it's a whole conversation. I think that the people who treat trading as a get rich quick scheme generally burn out and no longer are traders. And so the ones that continue on it are oftentimes putting something back into the space, maybe paying it forward by teaching or mentoring other people who are trying to come up in that space, or have using that money to do different things with it and are using it as kind of a launching pad. But I think that that's a beautiful energy behind, like, what you pour into will magnify back at you, and by adding value you're creating a stronger asset. And I think that that's a great example on how you probably ought to operate in real estate. I don't know that every real estate person does that, but it makes a lot of sense to me. And creating the better real estate opportunity is going to pay you more on the back end, because the higher value, people want to be there, they want to stay there, they like the community that you're building. That's nice.
Yeah. I mean, we don't really make money on like the market appreciation. If we does, it's great. But I would prefer to be trading in a flat market to kind of, I don't know. It's like if you're good at a certain sport, you don't want any weird wind conditions. Or I'm watching the Olympics nowadays. Just like, if you're the best skier, you just want flat, smooth snow to ski on and to
Yeah.
let the best skier win. In a
Yeah.
way,
To
that's
operate
what's
your
also
craft.
nice. Yeah, I mean, it's sort of a non-competitive sport that we play too, right? Because there's thousands and thousands and thousands of apartment buildings
Yeah.
there. And at the end of the day, when everybody's improving their properties, it kind of up levels the competition. Of course, the regular person out there doesn't like it because that's what's called inflation, and they don't want to pay more rents. But in turn, their living conditions are improving at the end of the day.
Yeah. Which has value. Like, that's valuable to that person.
Yeah, and so that's, I know, that's kind of where like it separates from, like this is an active business. Like we don't really build widgets and sell that, but in a way our widgets are the freshly turned nicer units that instead of paying $950 a month, now you pay $1,200 per month for it.
And would your goal be how long to hold your properties for?
Once we renovate the units and we bump the income, like you sell that thing as soon as you can, right? It's like a house flip, right? Like when these house flippers renovate the property, they sell it right away because the idea is that asset is decaying, just going down in value. So you just got to get, our value is when we're doing that turn. So if there's no more units to turn, there's not much for us to do, then we get out of it. It's just like you see the big guys thing, like Blackstone with their hotel properties in Las Vegas, right? They renovate a unit, they take over an older, more tired property, they renovate it, and then they typically sell it. No different, right? We're kind of the same thing.
Because then you stay in it too long, you're going to run into a situation where more damage is done and you have to re-renovate the same units that you've already done, and then you're going to have to be stuck in a loss period, maybe potentially.
Yeah, I mean, give people more of a tangible thing to think about. Like we'll typically buy like a 1970s, 1980s property. We'll renovate it. I'm sure people have seen, oh, this is kind of old, but I like it. It's new, right? Right? Like it's kind of the feeling. But make no mistake, it's still a 1970s property. And come a decade or two after there, it sort of becomes a little bit outdated. So you kind of got to just trade up and get out of it in a way. Now, I know like when you guys trade your guys' businesses, right? The switch to the stocks, it's a little bit different. But in reality, like you look at the S&P or the top companies, they all change out, right? Like all companies, pretty much all of them have had a increase and a death. Right.
Yeah.
There's very rare that you have a company that's been around for 50, 100 years. So in a way, it's sort of the same thing.
It makes me think about the way that the stock market actually moves, and it is making higher highs and then having pullbacks. So essentially you want to get in low and then ride the higher high where you create the money, the income there, and then you want to get out at the peak before it starts to depreciate again down. And so it is kind of riding the waves of like, get the most value you can, sell it, and then look for something else that's on the lower end of the push up.
Yeah, or maybe leave the game with a little bit of hedging on the side with a rental property or two, or syndication or private placement. I mean, that's essentially what like wealthy people will do with real estate. You run a business, whether it's like a laundromat or like a manufacturing plant, and your family is worth $10 to $20 million. What do you do? What do you tell your kids to do? Well, what they'll typically do is buy the real estate underneath them or other in the city, because they can have their idiot children run it. It's not that hard to go over there and collect rents. You just find a property manager to do it for you, right? And so that's kind of what's good about real estate. It's super easy, and the business doesn't really change, right? You want to rent this place? Oh, how big is it? Right? Okay, I'll trade you this every month. It doesn't really change. And it can, especially if you don't use debt, it can make your kids look like it's sort of a very much of a hedge strategy. The problem is there's other ways you can make a higher yield than doing it, of course. But as far as like the risk reward profile, it is probably the most archaic and lowest risk business out there.
Would you have an opinion on buying residential properties versus businesses? Do you do it?
So because we do value add, right? Like that's how we make most of our money, right? Do the value add. So when you're buying a house to live in, you're not doing any value add to that. And again, like when I was talking in the beginning, you want to stay away from properties that retail investors or retail home buyers are buying, because you're going to be getting into competition with somebody who loves their house. So this is kind of like people ask me all the time, like, should I buy my house to live in? I say most people should, because they're really bad with their money, right? They're in credit card debt, or they have money and they spend it. So by having a house to live in, it sort of becomes a forced piggy bank by having to pay their mortgage. But I tell people like, hey, if you guys are good with your money, able to save $20,000-$30,000 a year at least, you're probably on the other side of this coin. You're on the edge of the coin, in fact. And you're probably going to get a higher ROI by buying real estate as rental property stock or trading it. But if you mess up, then you have no place to live to, right? You got to rent, which I mean, isn't the worst thing in the world. In some places, it's actually cheaper to rent dollar for dollar. But, it kind of like, is like you say, like, oh, should I do S&P 500 or should I trade? And it's like, well, if you're not super smart, do the S&P 500, right? But if you can decipher and learn and able to ascertain risk and able to stomach risks, then this could be a good path. And
Yeah.
that's what I tell all my investors. Like obviously it's changed my life. I'm very passionate about it, but I do understand the risks of it, and it's not for everybody. That's for sure.
Yeah. If someone were interested in it, where would you direct them to start necessarily?
I usually direct people to my book, The Wealth Elevator, which came out last year. I think it does a good job of like talking about these different levels of the wealth elevator, because I always just kind of tell it through the lens of where I was, right? My experience shares of going through non-accredited investor status, and then younger accredited investor status, just above $1 million net worth. And then the third floor of the wealth elevator, getting up to 4 or 5 million net worth. And then there's beyond in the book. But the first step is always figuring out where you are today. Like what's your cattle grade today? What floor of the wealth elevator you are today? Based on where you're at, I think the path forward could be a variety of different things. If you don't have money, like don't read my book, go and trade, right? Or go flip houses.
Start
I don't
saving.
know, go find a job.
Yeah.
Right. If you've got like a net worth of $500,000 or you're already a credit investor, check out the book. And I think that's where the options kind of really open up. But again, like there's very rarely books written for the accredited investor out there. Most of them are like Dave Ramsey, CC Orman. I think they cater to more people that are in credit card debt, trying to get out of that stuff, which I think is the majority of people out there.
Right.
But, I think for people who are good with their money or got a good trading system going or have some rental properties, there really isn't much out there. So kind of, I would say, read my book.
Yeah.
If people buy it on Amazon and send me the receipt, we'll come up with the PDF version to ChatGPT and ask the questions from it, or we'll give them the MP3 version in case they're like me and can't read too well.
I do love me an audiobook, I'm not going to lie.
Yeah, I can send it to you.
I think it's a good, what you just said was really valuable, because if people are still trying to figure out if this is something they can do, priority needs to be not being credit card debt and start saving. And then once you have a little pile of savings, then that's when you can really figure out how can I make this savings grow and work for me. And so then that's when we really need to start digging into this and where to start intelligently and protect yourself with it.
We primarily help first generation multimillionaires. A lot of people in our camp are good savers, or find my book, and we kind of teach this triangle, right? Invest in alternative investments, the taxes, and infinite banking, and this kind of trifecta of strategies is very powerful. And what I've kind of realized that a lot of high net worth people will implement in their family. And to me, a lot of this is financial education, but for more accredited investors. And if you're able to implement these strategies, I mean, this is something very you can pass this on to your kids, I think.
And I love that you bought your first property. Would you say 2012?
2009. Yeah.
2009. Okay.
Yeah.
So, and look where you are now. And like this isn't something that you had to learn overnight. Like you're not saying that people can go to becoming a multi-million-dollar investor right away, but it's something that you start to learn. You start to ask the good questions. You find good resources such as your book, and then you start to save and build and grow, and to not think that this needs to be a get rich quick scheme either, but something that is worth the time and energy to learn and potentially use if you have any sort of extra income. I think that is a beautiful part about it. I think people who rush the process or think, if I can't be a millionaire by next year, this guy doesn't know what he's talking about. I think that I love the aspect of like, let it take time, learn what you need to know, start where you're at, and then think about the big picture in 10 years down the line. Because I mean, when you in 2009, maybe where you got to by 2019 was probably pretty freaking cool.
Yeah. I mean, I bought the duplex a few years later in 2012, and then 11 rentals by 2015. But, from 2009 to 2015, 11 rentals, that's a long time, like 6 years. But yeah, it is not a get rich quick scheme. That's for sure. If people think it is, they probably don't have very much money. I'd say
yeah.
Yeah.
Learn all the things first.
Yeah.
Well, thank you so much for your time. Do you have any last minute thoughts about any traders who are really interested in diversifying into real estate?
Yeah, I would say if you're a non-accredited investor, check out free e-courses on buying like a remote rental property at thewealthelevator.com/turnkey. If you're already getting to be accredited investor status, go to thewealthelevator.com/syndication, or shoot me an email, Lane@thewealthelevator.com.
Okay. And I will put all of those in the show notes. So you just click on the notes underneath this podcast, wherever you're listening to, and that will all be there, and then you guys can find you. Because I really enjoy this conversation, Lena. I think that what you've done is awesome, and I appreciate you speaking to the traders in us.
All right, guys. Thanks for having me.
Yeah. Have a great rest of your day. Bye, everyone. Take care.